A valuation method commonly used by venture capital investors when looking at startup companies involves a projection of the possible return on investment. The beauty and intrigue of this method is that a value is placed on the company with little reference to the technology, the team, milestones achieved, or momentum generated to date. In fact, the only information an investor requires from the company is a copy of the Capitalization Table. With this information, details of the amount of money the investor is injecting, the value of the company at a point in the future, say 3 years from now, and how much the VC wants its investment to be worth at that point, the investor works out how much of the company it needs to own today, and from here it can determine the current company valuation. As an example, the investor may estimate that if all goes to plan, the company will be worth $100 million 3 years from today. At that time, the company valuation is estimated at $100 million, based perhaps on comparable deals, earning and revenue multiples. If the total number of shares issued by the company in 3 years' time is estimated at 20 million, after allowance for future rounds of funding, and the VC wants to own 15% of the company at this point, the investor needs to acquire 3 million shares. If it's going to achieve a 10x or 1000% return on investment, the VC needs to buy 3 million shares today at a price of $1.5 million. So with 10 million shares outstanding today, before shares are sold in later rounds, this sets a value for the company today of $5 million. The investor needs to buy 3 million shares for $1.5 million. So the share price is 50 cents per share. With 10 million shares outstanding and a share price of 50 cents each, this values the company at $5 million. This return on investment technique drives a large number of early-stage startup valuations.